Hello, I'm Ted Oakley, managing partner here at Oxbow, and we're going to be talking about our quarterly investment call today. We'll be covering the economy, the bond market, stock market, many things along that line. I just got off a television interview this morning, and the number one question I had that I had to go over and over again was about the coronavirus, and we'll talk a little bit about that too, about what the implications might be for the world GDP and that sort of thing. So let's go to it right here and take a look at where we are with this coronavirus. One of the things you'll notice in this particular graph is that the number of weeks it took for all these cases to really come up has been much, much shorter than what it was for the SARS epidemic, which was some 17 years ago. Also, you'll see the number of deaths and the number of cases. Everything has exploded much, much faster. So what happens is, and you'll look on this graph here, you'll see the trajectory of what's going on here. And one of the problems we've had obviously this week has been that China has had a hard time measuring, let's say, what's really coming out of that. So from that standpoint, what it's going to affect is, yes, the deaths of the people and the people that infect. What it really is going to affect is world gross domestic product and what's going on in the world. If you look at the airlines, almost every airline has cut down flights and stopped flights all the way through March now to China. Auto sales, retail, furniture, textiles, all of the stores that sell fast food, all that sort of thing. Starbucks closed half their company. So it will have some impact. We just don't know what the impact will be at this point. So let's talk about the economy today. And if you'll notice in this graph at the lower level, you'll see where this has been the longest move in economic expansion that we've ever had. And before you jump up and down about that, if you look at the right side, you'll see it's also been the very smallest. We've only moved at about a 2.3% rate annually, which gives us concern as to why the budget office would be thinking we can grow at 3% this year when we haven't the last 10 years, particularly with all the government debt they're piling on. So we've had an economy it's gone a long period of time, but hasn't really gone anywhere in terms of high growth numbers. The other thing that's happened is we've had a big stock market in this length of time. And if you look at it, normally the stock market will follow what the economy does. You have a good economy, the market moves right along with it at the same level or same percentage as they go. And so there's a correlation between the two, highly correlated. If you'll notice here, and this gives some periods here of the decades, this particular decade we just finished, the market was only 7% correlated to the economy, meaning the market's growing much faster than what the really true economy is growing at. We'll talk about that in a minute, but what that really means is there's another outside reason for that, and it's not the economy. So one of the things that's going on that's been positive in the economy, and we've seen it really now for the last 5 months or so, is the mortgage rates have come down to a lower level. And that's caused two things. That's called refinancing has picked up, and at the same time, new home sales have picked up as well. They're not back to what they were in the big periods really 10 years ago or 15 years ago, but that's still something that's been a benefit to the economy. You'll also notice that one of the things that's happened with all of this is that the unemployment rate, I should say, has gone to a low level and stayed at a low level. There's a couple of reasons for that. There are a lot of people getting out of the workforce that are older. I'll give you a number. 76 million people in the country today, which is, if you figure 335 million people, 76 million people, average age today, 65 to 66 years old. So you can see what's coming out of that workforce number. And we're sort of caught in between here, and then we have a lot of jobs that people aren't really ready to take on. So they've all gone to work, but a lot of them are in lower levels. And so that's been a positive, and you'll hear the Fed look at this all the time, but it is a lagging indicator. It's not a leading indicator of what's going to happen. One of the problems with all of that, and if you wonder why doesn't that move into a booming economy, talking about 4 or 5% growth, is this slide you'll see right here with average real earnings year to year. So if you look at real earnings, which is after inflation, and you look at those numbers, they're zero. In other words, really adjusted for inflation, and they weren't but 1% anyway, but now adjusted for inflation, they're nothing. That means over the past year that if I'm an average worker, my earnings have gone up zero, while other costs have gone up. The second thing we'll talk about probably is the bond market, and just to give you an idea of what's going on. As you know, we have been one of those groups of people that said rates are coming down. We said it starting in July of 2019. We kept on saying that even after this 3-year bond peaked at over 3%, 3.2 the early last fall, and we've continued to say that here. This graph was put out a few days ago, but you'll see the 10-year bond from January 1st until now has continued to decline. We're actually today we're a little below that. We're around 158 on the 10-year. Let me give you some facts. Mexico just lowered their rates. You'll notice that if you look at the UK rates, they're under 1. If you'll notice also, this is incredible, but Greece, which is in junk bond status of a sovereign bond, just went below 1% this past week. And in addition, for the first time ever in the history, the U.S. sold their 30-year bond issue this week at a 2% number. So if you look and see what's happening between now and what it was, let's say, a week ago, you'll notice the blue line is the line of rates, and it goes from basically 1 month all the way to 30 years. And that's what the yield is. The yield is on the left-hand side of this column, and if you look at the red line, that's what it is today, and we're actually just a little bit lower than that today. Now, when you talk about an inversion, if you'll notice from 1 month out to about 7 or 8 years, the interest rates are actually going down. And I know that sounds contrary to you because if you look at it, you think, why would I buy something at 5 years that gives me less money than something at 1 month? Here's why. Somewhere along in here, we think the Federal Reserve is going to be driven to lower the federal funds rate. The federal funds rate, which is 175 right now, and they're trying to keep it around 160 to 165, the actual rate, is higher than the Treasury, than any of these Treasury rates you see right here. What that really means to you is that somebody's out of kilter here. And the bond market is telling the Federal Reserve, it's you. It doesn't surprise us. It's a group that's full of academics, know very little about what goes on in the street. So we see that coming in time. And I know people are going to say, well, that can't happen, and we think rates have bottomed out and they're headed up. There's some reasons you can't get that. But the other side is, I'll just give you an example. Look what Canada's done in this same period, but this was a month ago. And you'll see how dramatically they lowered, the rates have come down on their paper. It's something that it's had a big impact. It starts to impact the whole world worldwide. The other thing that's happening is, and this is very, very important to inflation, and without it, you never have any. Velocity of money is how often money turns around in the system. It goes something like this. I borrow money from the bank. I take that money and I bill something. Somebody makes money, my vendor, does business with me. They borrow money from their bank, and the money turns, and the velocity of that money turns, which grows the economy. What's happening now is we have virtually, our turnover in the velocity of money is really going down. Now this is M1, but M2 is even worse. It's about 1.4 or 1.5. So as we go forward, that's something to keep in mind because you can't have inflation if velocity is lower. So let's move on to the stock market, and the biggest question we get all the time is, why is the stock market going up? Now for us, it's simple. It happened during went all the way back to 2008 and 2009, when the Federal Reserve decided that the way to pull out of this deep, deep recession was we're going to make stock prices go up and real estate prices so that people feel rich and they spend money. Well, they did that, but it only affected a very, very small percentage of the economy because they're the only ones that own stocks and own a lot of real estate. But here's what happened. And this graph right here, you'll see this color graph. It goes back to last September. In the September, what happened in the repo market, which is the repurchase market, the repurchase agreement is if I'm a bank or an institution and I need money overnight, things are kind of tight. I've got some money coming in tomorrow or the next day, and I want to borrow some money overnight, then I can go into the repo, what we call the repo market, and borrow that, and someone loans it to me. If that rate goes really high, that means that things are tight. There's something wrong and the liquidity's not what it should be. It's similar to what it was in 2008 and 9. If you remember, you couldn't get a loan. The money was tight, so they had to push money in to the system so that everybody had enough money, and they said, okay, it's all right, I can get money here, I can get money there. Unfortunately, they put too much in. That was the problem. But this is another problem. This is telling you that we're in the late cycle of the economy, and yet there's not enough money floating around. If you'll notice all these color codes, what they're telling you is the Fed put money in the system, and they've been doing it since basically October 1st. In the next graph you'll see is the telltale sign. If you'll notice the red line, and it's basically factored to the right-hand axis, okay? You'll notice they put money in all the time, ever since October 1 of last year. Since they started that, notice the blue line, which is S&P 500. You see what it's doing? And what that means is everybody looks back and says, hey, the Federal Reserve has our back. We don't have to worry about it. You get a market drop, they lower rates. And it's a big smokescreen. This is the biggest problem with all of that. Because when you look at really what's going on in the marketplace, if I take you back over the last 7 or 8 years, which is one of my personal pet peeves here, okay, that corporations, you'll see on the left-hand graph, have borrowed all this money. But if you look at the right-hand graph, all they've done is buy back stock. So if you look at their real absolute earnings, real absolute revenue, it hasn't really done that well. But what they've done is they've been the biggest buyers of stock, much bigger than individuals, in this whole 7 and 8 year period. And it's been a system where they buy the stock back, and you'll notice someone, for example, like MGM, which is having a tough time with everything going on right now. What do? Times are bad, they're not making as much money. They buy their stock back with the money they do have. That goes on all the time. You see it happening. Someday this will come to an end, and that is the big underpinning behind the stock market. It's not something that we feel like should be happening, because it's really a system designed for upper management, in our opinion, when you get right down to it. But for whatever it's worth, it still goes on. The other thing that's happening right now, you'll notice, is that if you look at the two things that we look at that you cannot rig, for example, you can rig earnings per share by buying your stock back, okay, because you decrease the number of shares. What you cannot rig, though, is the price to sales. There's only a certain amount of sales, so if the price of my stock relative to sales, I can't rig that, okay? And I can't rig my enterprise value to my pre-tax profit. You'll see both of these are at levels we've not seen since the 99-2000 bubble. And that's why you'll find us to be reasonably liquid in our stock accounts and not buying as much as we were before. Give you an idea of what happens around here. Not for us, but for Wall Street. They will start, if you look back over the last 12 months, they start estimating what they think the first quarter 2020 numbers are going to look like. Are they going to be plus, minus, whatever? If you look back, all the way back to last year, a year ago, they thought they would be 12% higher than the year before. In other words, April 1 of 2020, first quarter, would be 12% higher than April 1 of 19. What they've gone down to now is barely 0.75%, and it may come in negative. So you see what's happening is you have a market that's continued to be moving higher, and people are out of touch of what's really going on. Let's talk a little bit about where we think we ought to be and why we're doing what we're doing. If you look at the number one thing, we're still looking for lower interest rates. We'll be surprised if rates don't surprise most people over the next 12 months. And I find people not being very risk averse right now. The complacency level is extremely high right now. People aren't worried about anything at all. I find them to be excited about their real estate, excited about their stocks, their 401ks, all that sort of thing. Everybody feels great. Reminds me so much of 99 in some particular ways. But we think what's going to happen is those rates are going to come on down, and you'll notice where I think people are thinking that, hey, I'm okay on that part of it. But if you go low enough, you'll get in a position where nobody has any cash flow, which will be a real problem in itself. Stock valuation's extremely high. If you look at the earnings on the S&P, we're looking at 19 times, maybe 20 times if they come in flatter. If you look at the times when you start investing, when the S&P numbers are more than 14 times, you just don't get the returns you normally get from other things. And we're out there looking for companies all the time. If you look at, you just received something from Chance Finucane, our Chief Investment Officer, last week, talking about the fact that, we try to upgrade the companies we own, but the pickings are slim right now. So what happens is, if you look at some of the surprises that come out of this, the number one surprise we think that's going to happen is the Federal Reserve will be caught off guard. They're even thinking about stopping in April the money that's coming out of the repo market. They're thinking about stopping that, okay? And we'll get a really good look at that point in time to see if liquidity is what they think it is. The second thing is, we think they're totally hung up on the unemployment rate. We don't think they look at many other things. Because if you look at worldwide, Germany almost in recession, some of the large economies, China, we thought China was weakening anyway, but they normally grow at 6%. They'll probably be lucky this first quarter to grow at 1 or maybe even 0. It's going to have an impact on some things. And this idea that we just do a V-shaped recovery and everything's fine by the time we get to May or June, that may not work out exactly. So that to us will be a surprise to the Federal Reserve. The other thing is the coronavirus could be larger than expected. It's something we don't know. I wouldn't even go as far as to say we could even predict it or anything along that line, but what if it is, okay? That's the point we're making. If it is, that makes the Federal Reserve even less hawkish and more dovish on lowering rates. Next, you'll see on quarter 1 and quarter 2 gross domestic product, we feel like will not be the number that people expect. We just feel like those numbers will come in. If you look at fourth quarter GDP, it would not have been where it was if imports hadn't gone down. If imports had stayed normal in the fourth quarter, what we would have had is a GDP number well under 2, okay? But it came into 2.1. It was 2.1 the quarter before. It's been in a declining mode the last 4 months, and we think quarter 1 and 2 are going to give us some problems. But that gives you potential buying opportunities, and that's one of the things that we're looking at right now. If you look at the types of companies that are really in the dumps, it would be the energy companies are really in trouble right now in terms of their pricing. But there'll be somewhere where those companies there's going to be some value in those companies. We'll be looking for other companies that will. One of the things we're staying away from are companies that have really high debt. We're staying away from companies where we don't think they can repay the debt. And you'll see in the bond portfolios we're running right now a very, very, very high quality level of bonds. Quality will be important going forward over the next 12 months. Hopefully you learned something today, and if you have any questions about all that, certainly give us a call or contact us at oxbowadvisors.com.